On October 3, 2024, the Bank for International Settlements, BIS, triggered a signal for coordinated global inflation, an action that will pivot your financial future today. Most people had no idea anything had happened, and many never will. But central banks are different. They feel inflation the way a watchman feels the wind shift before a storm. 3 weeks before that moment, G20 CPI had jumped to 4.1%, while real rates on short-term sovereign debt slipped into negative territory. A minor disturbance to the public, but to the monetary machinery, it was an omen. From Washington to New York, numbers that should have been lifeless began to behave like living organisms. They bent, twisted, and nudged balance sheets into a new orbit. Analysts in D.C. whispered that 2024 became the year U.S. federal debt surpassed $34 trillion, but still grew cheaper in real terms as inflation quietly eroded it. It was a double game, an economy that denounced inflation publicly while nurturing it privately. And caught between those currents? Ordinary Americans unaware their wallets were being used as the sacrificial buffer. In Manhattan, the financial district felt the shift before the government admitted it. The 10-year Treasury yield moved around 4.3%, like a creature waking from a long sleep, slow, uneasy, but signaling risk. Veteran traders said the market was smelling something the reports weren't ready. To name, central banks were letting inflation drift slightly above target. It was like a lighting technician raising brightness by just 2%. The audience doesn't notice, but the entire stage changes color. And when the stage changes color, the story changes direction. The US CPI rising 3.7% in September wasn't an accident. It was a deliberate step in a score the Fed had been rehearsing since 2021. When it quietly softened the definition of price stability. What they didn't say aloud. Price stability was no longer an absolute goal. Just a curtain masking a larger one softening the real burden of debt. With federal liabilities expanding faster than GDP, no solution works more cleanly than allowing inflation to sand down the edges. And American history has always favored the invisible wound over the public amputation. The BIS understood this, and its October report was only a reminder for those willing to read between the lines. It warned of a rebalancing of global interest rates. A phrase that sounds technical but is really a coded admission that central banks are prepared to tolerate higher inflation to keep the system breathing. When emerging market reserves dropped $92 billion in 5 months, that wasn't peripheral turbulence. It was the first crack on the ice. And that crack always echoes through Wall Street before it reaches your kitchen table. Those who live inside America's financial world know inflation isn't a monster, it's a tool. A dangerous one, but indispensable when every alternative leads to structural breakage. The government needs nominal revenues to rise. Corporations need top-line growth cushioned by higher prices. Banks need asset values to outpace funding costs. When all these needs converge, a silent consensus forms. And that consensus is always written in the language of inflation. In the 1940s, the U.S. used the same technique to dissolve wartime debt. Interest rates were pinned down while prices climbed 7 to 9% annually, quietly shifting the burden from the government to the public. If you've ever heard older Americans talk about prices rising faster than wages, that was the residue of that strategy. And the irony, the fewer people who understood the mechanism, the better it worked. Inflation doesn't need affection, it only needs to be ignored. This feeling is repeating itself, only now it's modernized, disguised in metrics, wrapped in technical phrasing. When the Fed repurchased $86 billion in T-bills in Q3 2024, the message wasn't in the number. It was in the cadence. They were injecting just enough warmth to keep the system alive. Not hot, not cold. Warm, exactly warm enough for inflation not to die. It was the slow knife. The blade moves so steadily that no one notices the bleeding. Economists like to talk about long-term inflation expectations, but those expectations are being ironed flat by the central banks themselves. When you control interest rates, balance sheets, and reserve flows, you control the economy's sense of itself. A 0.1% uptick in the PCE doesn't keep anyone awake at night. But it's like the conductor's subtle nod, barely visible yet decisive for the entire orchestra. And in America, that orchestra always plays the same underlying theme. Rising debt, rising prices, a public adjusting rather than rebelling. Media outlets love the phrase, the fight against inflation. But behind closed doors, the real question is always, how much inflation do we need to prevent the system from collapsing? A question as cold as it is practical, like a field surgeon deciding how much pain a patient must feel to stay conscious. And once you hear that question, you understand why the truth never leaves the room. It's not a secret. It's just unspeakable. Capital flows in 2023 rose only 0.7%, far below the 6.4% surge 2 years earlier. A slowdown like a shadow flickering across a wall, brief but telling. When capital won't run, the system must create momentum elsewhere, and the easiest momentum is price momentum. Higher prices make revenues look fuller. Fuller revenues make markets feel safer. Safety draws capital back. A loop only visible to those standing at the center. For Americans, everything translates through price first: homes, cars, beef, rent. That's why inflation becomes the unofficial dialect of policy. Not because the public understands it, but because they feel it before they understand it. And something that can be felt but not grasped is the perfect instrument for steering behavior. Inflation reports throughout 2024 keep repeating that 3 to 4% is manageable. Manageable for whom? Manageable for the system. Not necessarily for savers whose cash loses value each quarter. But the system was never built to protect cash, it was built to protect circulation. And that circulation is beginning to warm again. Look at history and the pattern becomes unmistakable. Before every major debt cycle resets, inflation is allowed to loosen its collar. Not enough to cause panic, just enough to soften the ledgers. In 1974, the UK used this script. In 1985, the US used it when the dollar grew too strong and crushed trade. These aren't footnotes. They're part of monetary DNA. Now the signs are appearing again in America. Yields suspended in uncertainty, federal debt hitting new highs, CPI refusing to fall back to 2%. Three pieces that seem separate are slowly locking together like the hinges of a heavy steel door preparing to close. And once that door closes, only one path remains for the government: letting inflation perform the job no one wishes to admit publicly. An old strategy that never goes out of style. What makes this story unsettling isn't high inflation. It's intentional inflation, inflation nurtured to look like coincidence. Inflation released slowly enough that no one has time to shout. It has the necessary impurity in a system that cannot survive an air too clean, always needing a little dust so the immune system doesn't to fall asleep. Throughout 2024, every report from the IMF to the World Bank hints at the same point. The 2% target may no longer be appropriate, a quiet sentence with violent implications. Change the target, and policy changes. Policy changes, and behavior changes. Behavior changes, and the public's finances shift last, like an echo arriving late. But the shift always arrives. If you watch closely, the clear signal isn't in the data, it's in the posture. The Fed no longer insists on returning inflation to 2% at all costs. Instead, it speaks of flexibility. In monetary policy, flexibility is the password for scenarios too delicate to name. And when the Fed turns flexible, the markets become predictable in a frightening way. This is the moment you feel the reversal, not as a shock, but as a rhythm. The numbers move in a single direction with the steadiness of an unseen hand keeping tempo. Not too fast, not too slow. Just enough to convince you everything is fine while the foundation shifts beneath your feet. And now, you can sense what only long-term observers dare to say aloud: the current has already begun to shift. You notice the shift the same way you notice a faint vibration in steel, not loud enough to alarm you, but too steady to ignore. Deep in the machinery of the financial system, the pipes carrying liquidity begin to resonate, as if the pressure inside them has changed pitch. Bank reserves edging down toward $3.10. Trillion feel less like a statistic and more like a soft groan from a structure carrying too much weight. The reverse repo facility draining below $600 billion becomes another quiet exhale, one, the public one here, but the walls of the engine room hear clearly. And when the walls start listening, you know the system is preparing for something it won't announce. Short-term funding markets respond first, almost shyly. A few basis points of widening in commercial paper spreads should mean nothing. Yet in a leveraged world, a few basis points can behave like cracks forming under fresh paint. Treasury issuance surging past $1 trillion in new bills doesn't shout, it presses. Presses on collateral, on liquidity, on the thin membrane separating stable math from unstable reality. And pressure rarely stays where it begins. Then the expectations shift softly, but decisively. 5-year break-evens, drifting beyond 2.7%, don't behave like forecasts anymore. They behave like prophecies. Markets start adjusting to a future that policymakers still pretend is negotiable. It's the moment the slow knife enters, quiet, precise, and unnoticed until the warmth of the cut replaces the shock of the impact. And by the time the public feels it, the blade is already halfway through. Corporations respond like animals sensing a tremor before humans do. They see the $1.8 trillion refinancing cliff between 2025 and 2027 and begin conserving energy, issuing early, trimming headcount, hoarding liquidity. These aren't panic moves. They're survival moves, subtle enough to look like strategy but close enough to fear to taste metallic. Balance sheets get heavier in all the places that matter. And heaviness is the first indicator of a coming pivot. Households experience the same shift, but in a different octave. Credit card APRs rising toward 20.7% don't scream. They tighten. Rent inflation above 6% doesn't shock, it accumulates. Student loan payments restarting pull $9 to $12 billion per month from consumer arteries. But because the bleed is slow, no one notices the color draining from the economy's face. Slow damage is the most loyal companion of inflation. It stays long enough to reshape habits. Inflation begins to behave like a character, not monstrous, but methodical. Prices adjust themselves the way a plant leans toward light, automatically, instinctively, without waiting for approval. A 0.2% monthly rise in PCE feels trivial until you realize triviality. Repeated long enough becomes architecture. Corporations test margins, consumers test boundaries. Policymakers test narratives. And the narrative most often chosen is the one that asks for the least honesty. Winners show their faces early, as always. Energy firms thrive on crude stabilizing near $90, a price that fattens margins without breaking demand. Land and metals appreciate not through enthusiasm, but through distrust. Copper up 11%, aluminum up 8%. As if the periodic table itself were hedging against central banks. Wealthy consumers keep spending at 3 to 4 times the pace of median households, creating a dual economy, one climbing the mountain, the other clinging to its base. Dual contrast becomes daily life. Losers don't fall. They erode. Small businesses watch input costs climb 4 to 5% while their customers resist paying more, creating a margin so thin it's almost translucent. Low-income families drop their savings rates below 4%, mirroring the final calm of 2007. Insurance premiums rise double digits. Medical care inflates 5.4%, and wages stuck near 4% lose their footing. Decline is rarely cinematic. It often arrives dressed as routine. Then the dominoes appear, not falling yet, but leaning. Treasury interest costs, climbing toward $1 trillion annually, tilt the first tile. Corporate refinancing into 6 to 7% rates nudges the next. International holders trimming tens of billions in treasuries tilt another, quietly repositioning for a different global rate regime. Dominoes do not need to fall fast. They just need to wait for the right angle. What follows is a timeline that feels less like prediction and more like gravity. By 2025, refinancing pressure collides with a cooling consumer. By 2026, federal interest payments overshadow infrastructure budgets, shifting priorities beneath the surface. By 2027 to 2028, corporate failures rise not dramatically, but constantly, a drip becoming a stream. By 2029 to 2032, the wealth map redraws itself. Asset owners consolidate, renters scatter, savers disappear into the arithmetic. Cycles aren't events, they're consequences. The institutions know this. The IMF slips in hints that the 2% inflation target no longer fits the world we built. The World Bank echoes the sentiment with softer phrasing. Even the Fed begins using the word flexibility. A word that only appears when certainty has left the building. Reversal happens quietly. The goalposts stay in place, but the field underneath them moves. Capital adjusts. Money market funds swell beyond $6 trillion. Commodity flows strengthen. Emerging markets with real positive yields attract foreign investors, searching for anything that behaves like truth. The United States still draws capital, but the tone has changed. Inflows feel armored, skeptical. Confidence hasn't evaporated, it has matured into caution. This isn't collapse. This is rearrangement. Inflation becomes the solvent that keeps the gears turning in a machine too indebted to run clean. Households bear it softly, corporations bear it strategically, and governments bear it rhetorically. And somewhere beneath it all, you feel the subtle certainty that the system is committing to a direction it won't admit publicly. A forest that refuses to acknowledge the smoke cannot blame the fire for spreading. That brings you here to the edge where intuition arrives before data, where the air feels charged even if the sky looks clear. The current is no longer shifting in hesitation. It is shifting with intention. And intention is the most powerful force in any financial cycle. You can step away from it, pretend it will pass, wait for the world to snap back to the narrative you grew up with. Or you can step closer into the room where the real map is being drawn quietly, layer by layer, far from headlines. The next movements will not be loud, but they will be permanent. If you want to see them before they arrive, step inside now before the next turn becomes irreversible.